14th of January, and you're listening to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 41st episode. Today, we will take on the highly exciting and dynamic world of digital payments. The fintech maven who will accompany us in that journey is Varun Mittal, a partner of EY Asia Pacific Financial Services Strategy and Transaction Services. Varun has extensive experience in digital business and strategy, proposition development, regulatory engagement, and corporate finance. Prior to EY, he was the group head of operations and merchant product management at HelloPay Southeast Asia, the first pan-regional wallet. Varun led partnerships with card schemes and acquirers to enable acceptance for them on Lazada and HelloPay in the region. HelloPay was later acquired by Ant Financial, or Alipay. He also has held key roles in Samsung, Singtel, Microsoft, and Gemalto. Varun is the founding member of Singapore Fintech Association and founder of ASEAN Fintech Network. He's the co-author of two books, Singapore Fintech Nation of the World and 52 Stories of Fintech Entrepreneurs. Varun Mittal, welcome to Kopi Time.
Good morning, Taimur.
It's great to have you. I've been looking forward to this chat for a while. Varun, we've had a few decades of progress in digital transaction and digital payment worldwide. Perhaps you can help us start the podcast with setting some sort of foundation, that your view on some exciting and promising tech developments taking place in this space.
Some of the biggest things which has happened in last 5 years, which will determine the coming 5, is last 5 years, the foundations for internet commerce and internet finance economy were built because smartphones became pervasive. The access to data, 3G, 4G, some places 5G became ever present. And there are more data connections than toilets and health clinic access in some of these markets. And what that did was a whole segment of economy came online, came digital, which brought its own efficiency, helped people explore markets and services beyond their immediate physical vicinity. And financial services was one of the areas where it hit, because now you don't need to only deal with the branch locally. Any bank across anywhere in the country could support you, and probably globally, depending on what you are looking at. So that removing of borders because of multiple sectors of economy embracing it, and it built over from the time of, let's say, when Uber started, and Uber and e-commerce companies and Netflix and the Spotify started, to what happened in last 1 year. All those foundations built were put into test. That, okay, now you cannot even do it digitally, physically. Everything is forced. And there will be a post-vaccine phase. I don't say post-COVID phase, because post-COVID, we don't know how it will look like. It's more of once you have vaccine in each market. For example, UAE will have 40-50% of their population vaccinated by end of March. The post-vaccine phase, when people can still do physically, but they will have option, they have got used to digitally, that will bring a sea change in the way the whole economy works. And we already are seeing cities like Miami saying we are the remote work capital of the world. And the companies will reorganize. And we will have something what happened post Y2K. Post Y2K, we had a scenario where companies started offshoring. And so there was the offshoring generation post Y2K. And what we will see, so 1999, 2000 brought offshoring. 2020, 2021 will bring remote work and distributed workforce. So this is, I would say, a newer version. We see strain of virus. Now this is a strain of work, new strain of work, which will come to impact all parts of life. And financial services being the common thread. When you want to do anything like that, financial services will have to be, I would say, one of the fastest one to evolve, because the Zoom communication, Slack, all of those, that's our solved. You cannot do a lot more innovation in that. You can still work on synchronous and asynchronous communication, because those threads do not have clear delineation. So there would be some work on that, but the real work would be how the taxes will be calculated, how access will be calculated, because every country has different principles. So that new world order for distributed situation, where it's a remote first, and physical will become very boutique, very, very specialized, as specialized as buying a shirt now. So only if you are very specialized and very rich, you have a custom tailor. Rest everybody is getting a ready-made shirt or trousers. So we
So
will see new fragmentation come out.
very interesting. So your point is that we have a foundation for a takeoff. Because I remember, a few years ago, among economists, there was this frustration that we see technology everywhere, but we don't really see it in productivity and growth. And the pushback against that argument was that take it easy. The technology is new. We haven't built infrastructure out yet, but once the infrastructure become pervasive, you will see the returns. So your point is that we are on that cusp, and the 20s could be very exciting in terms of unleashing of high productivity.
Absolutely, absolutely.
And Varun, the 2020 episode, when we were suddenly caught up with the COVID disease, I suppose was a good stress test for the global economy. That our bandwidth was sufficient to have 10x more video calls around the world and 10x or 20x more transactions, and looks like we passed that test.
In a lot of areas, yes, but some areas not. So I'll show you the reverse side. So the deplatformification of one app in US actually showed the other side, that everybody relied so much on shared infra that just if, for example, tomorrow American government decides we don't like this app, and you are knocked off all app stores and all cloud providers, how it looks like. So on one side, it showed the positive sides, but what it is showing is that there will be a decoupling of some order very soon, because people are realizing that stuff they took for granted, that this will always be available, is not. And when some apps can go down, tomorrow it could be your number.
Right. And I think I read recently the story about various TikTok entrepreneurs in India who lost significant amount of income when the ban came through in India, and that was certainly a big shock for them, because they, like you said, thought it was going to be there forever.
So that reliance on technology, people are realizing that you need to own your critical infrastructure and distribution. Just because you can outsource doesn't mean you should, because the day it strikes, you're wiped out. You don't have a plan B in place. Your plan B cannot even get a time to act.
So Varun, you're basically making the argument of anti-fragility, that even if it is a little more expensive to have your infrastructure, you probably should from a risk management perspective.
So I would say that you should have options. You may not be using it, but you should have options that, okay, if assuming all American cloud providers shut me down tomorrow, how will I operate? I may not be able to bounce back 100% capacity next day, but the way my infrastructure is designed, that I should be able to find a local telco to port my stuff and get back in 48 hours, for example. So I'm not saying you should have it, but your architecture should be designed in a way that, let's assume I switch off all of this, how much time it will take for me to bounce back to 50, 75, 100% traffic.
Right. I mean, as we saw 2 weeks ago, or was it a week and a half ago, when Parler, Amazon Web Services, so withdrew their services, Parler went offline. And they had to sort of scamper. I guess they will be back online at some point, but they were fully reliant on AWS.
And not just that, app stores. You are reliant on mobile, and in Asia, we have our own Asian app stores in China. But if you look at Southeast Asia, do you know anybody in your circle who has a two American oligopoly app store, unless you have a Huawei phone? Nobody has. So you get shot on that. It's not just the infra layer, it's the distribution layer as well.
Absolutely. Okay, so Varun, you on your day-to-day job look at a wide range of companies who are at the cutting edge of fintech-related developments. And I had lunch with you recently, and you shared with us very, very interesting insights on the developments. So give us a sense of some of the really exciting startups out there that you find particularly promising.
The kind of startups I like most are the ones which are going after the scenario that I can open the access. So earlier, the traditional financial institutions were serving physically. So they had to put artificial AUM numbers on everybody's head. You are 5 million, so you are private plus plus. You are 3 million, you are this. And because they had different level of people serving them, they would offer only specific products. And it was right from a 25-year-old construct perspective or a 50-year-old construct perspective.
Just to make it clear to our audience, so you're talking about the wealth management industry, and by AUM, you mean asset under management.
Absolutely. And even for example, if you look at remittance for an SME, if you are a company, if you are a SME business who has 100 million revenue, the kind of services a bank will offer you, you will be institutional client. But if you are a small SME at, let's say, 15 million revenue, you're a corporate client. So even the rates, the access you get are very different. And what we saw in last 5 years, a consumer says, when my Netflix is same as yours, my taxi company is same as yours, my iPhone same as yours, why should my financial services be different than yours? People understand and acknowledge, I buy 12 cans of Coke, they are cheaper versus I buy 1 can of Coke. So the bulk pricing being different is understandable. But just because I'm poor, I should not be able to buy the same Coke which a rich guy can. It doesn't make sense to people. So the companies which are using technology to open that access, whether it is for accessing alternate wealth products, whether it is for accessing institutional wealth class products, even US is passing the new version of the Jobs Act. It's getting enacted in a few months, where anybody with $100 can start to invest. Because if we are saying startups are going to create wealth, and if you are non-accredited investor, you're not allowed. So I have a right to smoke, I have a right to have marijuana, I have a right to have alcohol, but I don't have a right to invest $100 in a startup. It's, from that perspective, it's unfair. Let me decide what's right for me. You can stop mis-selling from a regulatory perspective. So regulations have moved, but the companies which are enabling that. So if you look at AngelList, Our Crowd, Equity Zen, Forge Global, these kind of companies who are opening access to the private market for people who earlier could not even dream of touching those asset classes. Similarly, companies which are opening paintings, art, wine, collectibles for retail class. The other part is retirement planning or heritage planning or succession planning. Earlier, any financial institution, unless you are $10-20 million worth, nobody is even talking about will planning and estate planning for you. Now, because it's tech enabled, companies are bringing that even if you are few 100,000 worth, for you, that's a lot. So let us help you plan that if something unforeseen happens to you, how do you help? The whole financial planning, management, simulation is coming to people at 100K level, something which was 2 million people. And similarly, I look at lending. Earlier, why a lot of SMEs could not get lending was because their data was not visible. Transactions were happening in cash. So even if a bank or a fintech wanted to underwrite, they couldn't underwrite it. Now, what they are looking at is we will help you digitize your business, but don't do digitization for the sake of it, because there are reasons why they did not accept digital payments before. I'll give you a very simple example. Assuming you are selling $100 worth of product where 5% is your margin. You are a restaurant with 5% margin. Accepting a credit card in Singapore will cost you $3. $3 on $5 means 60% of your net income is gone to accept cards, which doesn't work. But the idea is looking at, one, we cut down the cost of accepting digital payments. But when your revenue is visible, then banks as well as fintech lenders who are more agile can offer you credit to grow your business, accept digital payments to grow your business. So companies who are offering those kind of solutions, where they're saying, I will open that access for you, let me help you grow your business. So those kind of solutions, I feel, will create significant economic value. They are not value destructive solutions. If I look from an economic perspective, there are value destructive fintechs which are only saying, I will reduce the costs of this. And there are value accretive fintechs or startups who are saying, I will help you grow your business. I'll help you achieve more efficiency, help you sell your excess inventory to create net economic addition to your business. The net economic addition for me is the primary drivers, because you can destruct only a limited value. After that, you destruct yourself.
Varun, I want to go deeper into the area of wealth management, et cetera, a bit later, because I know you're quite involved in all of those developments. But you began the discussion by saying that we have in recent decade put a foundation of technology in place, and now we will need a layer of regulation around them for the entire ecosystem to flourish. So let's talk a little bit about the regulatory environment and innovation. In this area, how are things coming along?
So from broadly from a regulatory perspective, regulators have So the approach regulators have taken is what they call risk-based approach. But what in practice it means is when something becomes large enough, we regulate it. And there are territories which are not worth going in yet. If it comes to mainstream, then we will come to step into regulate. And just to give an example, so security tokens is an example. Once that became mainstream and loans and different assets started to become tokenized, regulators came in and security tokens are no different than security. Let them regulate it. There are gray parts which regulators still haven't figured out. For example, would like SEC is still suing companies saying you are security, not a utility token. So there will probably need to be a newer version of the Howey test. Howey test was 1920s, 30s, done in United States court, where the court ruled that following scenarios you will be treated as security, following scenarios you will not be. But that was done in a very different economic setup, very different economic culture. And I remember a quote from the movie on the former US Supreme Court judge who just passed away, that the laws are made for, yes. And she had a quote from her Harvard professor in the movie that the laws reflect not the climate of, not the weather of the day, but climate of the era. So, which is why the climate of the era has evolved from 1930s when the Howey test happened. And there will be a newer classification on these kind of things. So should companies be able to raise money from their customers directly instead of touching the public markets? Because I'll probably be open to that idea of, for example, the e-commerce company I'm using every day, even if, so why do they go public markets? Because they want to raise capital. The existing customers are willing. So these kind of models, when they come mainstream, where customers become part owners of B2C businesses or B2B businesses. B2B is still easy because they are sophisticated. For B2C, those kind of newer economic models are where the government needs to factor in. Other example is digital currency. So one big challenge which even MAS had to go through was, if assume you make dollar to be fully digitized. Today what happens is the banks have to keep a reserve and the central bank has to pay an interest and there is a structure. But if everything is digitized, every night you will sweep out everything to the central bank, because every time you send it back to central bank, you get interest. And every morning you will bring it back. Your whole economic foundations of the interest rate setting and the repo rates and the capital adequacy ratio will need to rewire, because the digital, because now it's an economic problem. It's not a technology problem. Technology will say, you want me to stop them swiping everything in? No problem. I will put a rule. But economists will need to come out with a model that how will interest rate regime work if you have 100% fluidity and there is no, or minimal cost of moving in, moving out instead of having that cash movement. So those are economic problems where regulators are like, we want to solve it, but we don't know how to solve. We need economists to define the interest rate regime of future.
No, I mean, I did a fireside chat with Augustin Carstens, the head of Bank for International Settlement, and he was sort of making the case that central banks have done an amazing job in the last half century in facilitating digital transactions at the institutional level with a very high degree of precision and security and massive quantity of transactions getting settled every day. So then I asked him, so are you saying that there are no payments problems that central banks cannot solve? And he said, well, there are many problems that central banks does not need to solve because private sector is more efficient and more innovative in dealing with those things. And therefore, we would like to have innovation. So then he had a very nice phrase or sentence, Varun, that you would appreciate. He said that in the spectrum of money creation and money spending, it's wide enough that there's room for both central banks and financial technology companies and banks. So yes, you're right that a lot of unfinished business on the regulatory side, on payments, on central banking, on digital currency. So you began touching on the digital currency issue. So let me ask about the cross-border payment question, because I see a lot of innovation happening within a country, even China, massive, fintechs out there dealing with hundreds of millions of customers, billions of transactions every single day. But when it comes to cross-border payments, life gets a little more complicated because at the end of the day, authorities worry about money laundering, they worry about illicit transactions, hence they want oversight, and they want to thread that balance, which is on one hand, I want to promote innovation. On the other hand, I want to make sure that security, transparency, oversight is there. So walk us through where we are on cross-border payments, and are we going to see any breakthroughs, or this is one area where regulation will remain fairly overbearing?
See, the reason why regulations are or have been overbearing on cross-border payments is because of the concerns around terrorist financing, money laundering. And what happens is the cost of that is typically borne by the weakest customer, not the strongest customer, because the strongest customer have a lot of other vehicle structures to manage, but it's the last mile laborer who is earning $10 a day and sending back $5 a day is this micro transaction. And again, I'll go back. This current cross-border system was built on foundation built in 1950s and 60s, where you did not have micro transactions, where the transactions were very large value. So the system was never designed for micro transactions because the system had a fixed fees component, and the fixed fee component kills the micro transactions. So which is why what's happening now for past 4-5 years, Asia, Europe, some parts of US is, I would say, slightly more, one of the most backward when it comes to innovation in cross-border payments from that perspective, has been that fintech companies are saying, we will have a train and we will let the small customers put a cabin at the back so that you can ride the same institutional rail we are building and you can achieve the cost benefits. Of course, there are challenges to it. So one challenge is what they are trying to achieve is if you can achieve significant net offs, that the sending country and receiving country, you can bring close to balance. You can never balance it fully because there will always be more money going from, say, Singapore to Philippines than money coming from Philippines to Singapore. So they cannot achieve fully, but whatever they can, that's one side. And the other side is the cost of compliance. That's where the local regulators are coming in. Local regulators are helping digitally KYC the customers. So they reduce the cost of tracking, onboarding, and maintaining compliance. What I see is one side, SWIFT is bringing out GPI and all of those initiatives. So the existing financial institutions are looking at from a perspective of, can we embed ourselves into lives of people who have to do these remittances? Why do they need to get into another app to do remittance? Because then you can take off the cost of marketing, onboarding, acquiring, and remittance becoming an embedded solution. So the way I look at it is the way you walk off a cab without worrying about payment. Payment became an embedded layer. Cross-border payments will go close to that level where the cross-border merchant transactions will become just the payment seamless like. And companies have already done that in most markets and they're going further. But for physical actual money movement, the bottom of the pillar collaboration, we'll see cross-border corridor alliances come up where regulators are keen to enable it. From Philippines, so in my time when I was running the fintech, we did analysis that if Philippines can cut down the cost of remittance by 1%, today the last mile takes 2% to even give the cash out to you. If they can just cut down that 1%, they will be able to add 2.5% to their GDP because that money circulates back. But when they are getting it to those companies, these are international companies and it's just wasted away. And that money leaves the country. It never stays in. And that money, if spent locally, will vitalize local economy. So that local alliances and local regulators saying, I will take care of your dissemination of money easily. I will give you InstaPay access to all the fintech so that you can send the money directly to people's wallets and bank accounts so that you don't need convenience stores who charge 2.5% to disseminate the money. So that is where the innovation, technology-wise, there is not significant innovation needed. A blockchain companies can say, we will do this. Most of these blockchain companies don't have liquidity, don't have that level of transparency, and they cannot handle even their 1 year volume is less than 1 day volume of the existing channels. So, and when you have tokens whose value go up, down 5-10% every day, I don't want to expose my family to that level of risk if I'm sending them livelihood money. So I don't see cryptocurrencies bringing like a technology evolution there. It's one of the several channels, but the real innovation is on the risk regulatory compliance on the termination and the origination ends.
Varun, you mentioned Philippines. I was thinking about South Asia, that between Sri Lanka, Bangladesh, India, and Pakistan, more than $100 billion worth of remittances take place every year. And even
Absolutely.
5 years ago, it was being done the way it was done 30 years ago.
Yep.
Hundi and Hawala, and sometimes, through formalized banking system with massive amount of spread. But today things have changed very significantly because of the advent of the smartphone and some of the digital e-wallets. But still, I think, as you said, it's not the technology, it is the enabling regulation and more interoperability that would probably create even more value and certainly reduce the cost of that last mile person, as you said.
Absolutely.
Please go ahead.
So the challenge, what has happened is there are local reasons why sometimes regulators are nervous to push hard for those changes, because there are local lobby groups who do not want that to happen. So imagine if everybody could get access to everything seamlessly, you will have a lot of middlemen who will lose value. So we see more of the economic structural challenges, because you need to create jobs for those people whose full-time job was money remittance agents. If you look at Southeast Asia, you will have just to give Singapore example. Singapore has 4,000 money changers, physical money changers where you change cash. 4,000 money changers means 14 to 15,000 employees. And you can imagine that these are not PhDs. These are not the most skilled, not the most educated. So let's assume in Singapore you bring as much digitization. Nobody who's traveling out of Singapore needs to do changes, all of that. What will you do for these 10,000, 14,000 people? So there are structural changes also. So let's assume government pushes all of this hard. What's next? How are you going to create jobs? So a lot of places, while I may be frustrated that they are not pushing hard enough, but when I sit on the other side of the table with them, they says, Varun, I can't create 14,000 jobs tomorrow morning. It will take me a few years to reskill these people.
Absolutely. I remember the first time I noticed this money changer phenomenon in Singapore, I was quite taken aback that on Fridays, if you walk around, for example, a Raffles Place, Change Alley, there are long lines in 2020 for people, trying to convert their currencies and sending it through them. And I thought that, Singapore was like all smartphone and all e-wallet. Not the case. And if that is Singapore, which has one of the highest smartphone penetration in the world as a share of population, you can imagine how much more progress or how much more development we have to go in other places in the world.
Absolutely.
Varun, you briefly touched on cryptocurrency in the context of cross-border payment. I want to talk about one specific issue, and then I want to talk to you in general about cryptocurrency. So the specific issue is Libra, that Facebook, floated the concept, got a lot of pushback from regulators, but I think there's a softer version of Libra coming out at some point this year. And the idea behind Libra was to address that concern that you just mentioned, that I don't want to use a token which has a very volatile value, goes up and down. Libra wanted to be a stable coin. It was going to be backed by US dollar. So if indeed a US dollar backed digital currency was out there, would it not solve the problem of volatility of, say, Bitcoin or something like that? And at the same time, given Facebook is ubiquitous around the world, wouldn't it immediately become a channel where everybody would be transacting?
So not exactly. And even they had to change the name of the project because there was challenges because one of the very large Chinese big tech owned the trademark for the word Libra. So they have to change the name of the project now. But what they have also figured out is that doing a USD only doesn't work. And that's why a lot of European countries and Asian countries said no. Because imagine, as a central bank, you are giving up your monetary sovereignty in the hands of another country, which can decide to print as many dollars as they want. Which is why the only scenario it could work is you have country-specific stable coins, which are held corresponding to a basket approved by the local central bank. Because if it is US dollar or any single currency, that's equivalent of that currency, a foreign currency becoming a quasi-legal tender in your home jurisdiction.
True.
So that's a non-negotiable argument from an economic perspective. As a central bank, I'll say, I don't even want to discuss. This doesn't work. You cannot replace my currency in my market. I control the supply, period, over. Yes, you are saying you will hold my currency as a repository in banks I regulate in my jurisdiction, and then you want to have a digital version. So technically, from a regulatory perspective, it's a fully one-to-one backed with the fiat digital version. So for them, it's e-money. When it's e-money, which is backed by one-to-one fiat, and so they have control over visibility and supply, that is the equivalent of e-money, and then they can have access, full visibility on M1 money supply. The reason Chinese regulator freaked out, they lost visibility on M1. So what regulators have learned, under no circumstance shall we ever cede control of M1 supply visibility to any private player, no matter who they are. So which is why any US dollar denominated stable coin doesn't help.
Right, Varun. So just to make it a little more clear for our audience, that you basically brought up the issue of once you allow foreign companies to carry out transaction within your own borders and get settled in foreign currency, you are sort of losing control in your own domestic monetary activity, because all of a sudden transactions are taking place in your country based on foreign currency, which is not allowed right now. And unless you have an extremely liberal regime, let's say Argentina, where dollar and peso are used interchangeably, that's fine. But in most countries in the world, authorities don't allow that. And then you sort of, took us into the issue that I want to actually get into, which is that in case of China, because you have extremely large financial technology companies which are taking deposits and extending credit, they're in a way becoming banks without being banks, and are of course, completely divorced from the fractional reserve system that the central banks typically use to create money in the economy. So M1 that you're talking about is, currency plus deposits, was something that central banks want to have control over through monetary policy. In the case of China, the fear was they were losing control. So thanks for bringing that in, because that's exactly where I wanted to go. So tell us about your view on this whole digital currency initiative that is going on in China.
See, the Chinese digital currency initiative is example of what I mentioned. One-to-one backed, regulators have full control, full visibility over that. All it does is it reduces the cost of moving physical cash at the end of evening for settlement. And it reduces the cost of storing currency in currency chests and stuff. That's what it is solving for. But regulators have full visibility, and it's a one-to-one denomination. There is nobody is able to leverage or deleverage it. So the fractional reserve control is with the government. So technically, these are digital. So from a regulator perspective, it's e-money. It's equivalent of a wallet balance, which is held in a regulated financial institution, 1:1 nostro. You can't put that in money market. So this Chinese e-currency money, you cannot put in money market. You can't even do it like overnight repo lending. You can't do that. It's sacrosanct. You can't touch it. So which is for a regulator, that doesn't destroy the foundations of the economic system. The moment people say, "Oh, can I do overnight lending?" I'm like, yeah, I remember German bank failing one night. I remember 2008 where overnight stuff fails, and just because even if you're doing overnight lending, it doesn't work. So you cannot lend. You can't touch it. So which is why the foundations of the Chinese system is you can't lend that money. That is sacrosanct, and this is just the digital version of our currency which we control. That's okay. No regulator is saying no for that. Every regulator in the world is saying we are fine with that. We are not. Even US, when they just announced that US regulated institutions are allowed to transact in US dollar denominated stable coins. OCC gave out this ruling 2 weeks back because they are fine, because that's equivalent of you giving a digital version of money you are holding physically. It's okay.
Varun, could the Chinese model also be extended to cross-border payments? I read somewhere that Huawei now will have this RMB e-wallet. So even sitting in Africa, if you want to trade with a Chinese company, you can do a transaction in RMB. But it would, of course, require the government in that country to be okay with that you're all of a sudden ceding control of your money supply to China. But do you see the ERMB initiative also being extended to cross-border payments?
See, I'll go back to the one step behind. The way countries will have to do cross-border trade, and the countries control, because they put capital controls to manage the stability of the domestic currency. So they control that in which currencies, how much dollars are going out or how much RMBs are going out. The premise is, if the country is a net importer of Chinese products, and Chinese, if that company is a net importer of Chinese product, and the Chinese exporter offers two terms. Okay, if you want to pay me in US dollar, here's my price. If you want to pay me in RMBs, because even if he receives in US dollar, he has to convert in RMB, because his labor, worker, and everything downstream is in RMB. So depending on what you are importing. So for example, if you are importing Chinese services, imagine I'm a country X, I'm importing Chinese services, then I don't mind doing it, because I can pay in RMB. I will get a better price from the Chinese exporter, because if I pay him in US dollar, he has to again convert it to RMB and stuff. But what if I'm buying is a processed good? For example, I'm buying clothes from China. China doesn't manufacture all the cotton. China has to buy its cotton from other markets, which it may have to pay in US dollars. So that exporter will try to hedge. They say, I can have half of my payments in dollar, half of my in RMB for my local spending. So the countries will have to decide based on, one, how many RMBs they need, how much is the net country RMB budget they need, and can they extract better terms from the stuff they are importing. If they can extract better commercial terms for the stuff they have to import from China, it makes sense. But if they do not have an advantage of that, then it doesn't make sense. The other part is, some countries may look at it as a hedge. They may reverse it. They may start quoting to their export partners that, guys, if you want to sell us, quote us a RMB price also. We have enough RMB supply now because of the products. Quote your price. So it's a two-way thing. So if the regulators decide that they want to broaden the currency basket, Europe is looking at some level of de-dollarization. I mean, they can't do de-dollarization, but they are diversifying the basket. Singapore is a perfect example. 1965, when Singapore became independent, British pound was one of the largest component in the Singaporean chest. And Singapore, over next 15 years, from 67, 73 currency crisis, Bretton Woods, they reduced the exposure. Of course, nobody knows exactly how much is that split, but Singapore reduced. Singapore acknowledged that, okay, pound is not the largest for sure. So which is why countries historically, they have taken a time, and reserve currencies have evolved. Singapore does a basket. Some countries do a not so complex basket, but basket will evolve, and it will be driven by what terms you get for your exports, imports, and what is your leverage on those. ERMB is no difference than every 100 years. Historically, every 100 years, the central reserve currency changes. Before US dollar was British pound, at some point was French, at some point was Spanish, Portuguese, Denmark. So it changed every 100 years.
I appreciate the way you sort of cut it down, that it is really about the bottom line. If countries can get preferential rates and find savings, then of course, they will be very happy to engage with China, which is, of course, in most cases in the world, the largest trading partner. I'm going to pivot a little bit. Varun, you've been involved with the digital banking rollout process in Singapore. 2021 and 2022 are the two big years here, having the licenses being given out. Can you give us a sense of how things are there and how you see the digital banking landscape evolving in the coming years?
Absolutely. So Singapore will have two full banks by next year. One internet-only bank, most likely, and two wholesale digital banks. That is in addition to all the neobanks which are coming in, which don't have a license, but use the infrastructure from the existing banks to offer financial services. So from a service provider landscape perspective, we will have more than enough options to come in. And Singapore, I would say, is significantly banked country. So the kind of needs and solutions which will be coming in Singaporean market will be slightly different than, let's say, Indonesia, where super apps just acquired banks and you have 100 million people which don't even have bank accounts, but they have access to those super apps. So the needs and aspirations for markets like Indonesia, Philippines are that this is the first time. The mobile phone was the first time they accessed internet. Super app will be probably the first time they access formal credit and formal financial services. So they will jump a generation, and that will be life changing for a lot of those people. What will happen more from a Singaporean landscape perspective is that niche players, and this is a testing ground for a lot of these players to test out these models, because we already have digital KYC, full cloud, much more mature regulatory infra. So there will be a lot more innovation around international trade, because it's a trading hub, international trade, international wealth management, those kind of things. I do not expect dramatical innovation in cards, because average Singaporean has 3 to 5 cards. So cards, payments will not be a dramatic innovation, but real innovation will be stuff which is aligned to the international nature and international character of the business. There are, however, areas which have not been served. I'll give a simple example. Singapore has about 340,000 foreign construction workers, another 340,000 foreign maids, and about 430,000 gig economy workers. These are people who are delivering Grab food, Shopee parcels, freelance photographers, dance studio people. Now everybody is teaching dance and acrobatics and all of this on Zoom. So all of these freelancing people, this freelancing people is a big challenge from an economic perspective. They don't have CPF. CPF is the Singapore mandatory retirement plan, where your employer has to contribute and you have to contribute, government guarantees some level of returns. So we have 400,000 people who, if you count their families in, that's roughly 30-40% of Singaporean population, who will not have a retirement kitty. And we are extrapolating. So while some of the Western countries are facing the scenario, they say 2030, 2035, we cannot fund our pension. Singapore can already see that we have a segment which will reach that problem. What can we do upfront? Can we have the app platforms, super app platforms who are serving this, to institute some kind of retirement planning, some kind of nudge? This is Asian culture. In a Western culture, they will probably scoff at forced saving, but it's not so bad for an Asian culture perspective. A bit of nudge forced saving is fine. How can we do that? And which is why Thurman announced very clearly, Singapore doesn't encourage value destructive competition. Singapore encourages unmet and unserved needs of such segments to be addressed. So which is why I see, because if any of these digital banks will go, say, head on to the incumbent banks, say we will fight at the top end of the segment, people do not have an urgency to switch there. But if they can go after this, I just listed out 1 million people population, they can solve these needs. And of course, they can go after other access issues and stuff I mentioned. But these are actual social needs if they can address, while of course the existing banks also needs to work to address this. So this is a social problem. So for Singapore, having more mobile apps and getting more bank accounts was not a priority for digital banks. Singapore, if you really want a bank account, you can have one, versus an Indonesia motivation or a Philippines motivation. So which is why I would say Singaporean context is one, that bottom segment of the society, to prepare them for 20 years out. Everybody worries about the 65-year-old auntie who is picking up utensils in the food court. You don't want to have a 5x that size of problem in 20 years from now. So we have to act now. So that's from that provider perspective, I would say.
Well, that's great. I think I'm glad that you sort of brought in the issue of digital banking with the implication for inclusion, and that even in a wealthy society like Singapore, the financial inclusion is an issue. Doesn't matter if everybody has access to banking accounts. It's a question of having wider range of financial services. So I'm glad that you brought it out, which of course underscores the point that in developing world, the needs and the scope for work is even far, far greater. To this conversation, Varun, several times you've talked about wealth management. So here's a chance to actually get deeper into that. I saw on your LinkedIn post a couple of days ago, you were talking about how the world of robo-advisors can even have performance-based fee structure and how that could disrupt the wealth management industry. Or rather, I think you used the phrase, democratize the wealth management industry. So go ahead, tell us a little bit about this area.
So traditionally, what happened was the performance-based structures were available only to super rich people because they will have specialized fund managers who will employ, I would say, specialized tactics, for example, hedges, shorts, those kind of tactics to generate returns beyond the normal. While for average people, there would be normal index funds, the ETF revolution. So you have passive funds. And passive funds are not bad. They're good for most of the people. But for people who have slightly higher risk tolerance and who have specialized needs, for example, they have currency exposures they want to hedge and stuff, there's the traditional performance based, because somebody needs to be compensated if they are gonna put additional effort instead of just tracking the index for you to generate additional returns, you pay. And I would say it goes back to the older times when you used to have the carry concept where you would hire a bunch of sailors. They go to fish the ship for you, fish for you in the high seas, and whatever stuff they bring back, they keep 20%. So the principle of 20% carry was performance based. You catch more, you get more. That was the origination. Of course, that came to both public markets and private markets. And while robo-advisors have been doing a fine job, and I personally still use a lot of them, but what they're doing is they're charging you fees for advice and execution. And they will say, we will map the index, we will track the index, and we will have a stable growth. There are people who say, I want to put 10% of my assets in performance-based, whether it's investing directly in startups, but they say, can I have that for public markets also? So now robo-advisors are saying, we will offer you that also. We will build it in-house or partner with those people. And this is one of the example of people are saying, if you think it's right, we are not saying you should do it. We are not saying you should put 100% of your portfolio in performance-based. But if you think you should do it, we will ensure that we enable access to you instead of we telling that you don't deserve it, don't try to do. So that giving the power of decision making to the end consumer by supposedly the traditional passive institutions is really valuable. The key question is, how does the performance based is executed? Will it also be passive? So somebody is saying, so robo advisors are saying our algorithms are so awesome that they will be able to beat the market returns, and then you pay us for that. Time will tell. Versus some of those other fintechs are saying, we will employ real humans who will actually do active trade for you and prove the returns. Active people say last 10 years was a bull run, monetary easing policy. So all boats rise when Fed pumps $5 trillion. You will see the active will bounce back. And there are generation. Active one, then passive one for 10 years. Now active will win. I'm nobody to say whether it's right or wrong, but performance-based fees will stay, will become a larger portfolio. Some people will do it by saying algorithms are awesome. Passively, we will generate more returns. Some people will do by active. Time will tell, and Fed will tell how much more money they pump.
That's right. That's right. Varun, you recently published a book, and you're a co-author of that book called the Fintech Nation, and you also have this Fintech Nation project. Can you tell us about that?
Absolutely. So I was one of the original founders of Singapore's Fintech Association 5-6 years ago. And at that point, it was not even called Fintech. It was just a bunch of payment people come together and says, we need a formal structure to convey our needs, coordinate with the regulators and stuff. And we brought that together. And over the last 5-6 years, things evolved and stuff. And 2019, I was in Israel, and Israel is known as the startup nation. And I saw how the culture was built, how the whole country came together. And I actually read that book twice because once was not enough. The word Startup Nation comes from a book written by 2 Israeli people about how they did it. And I reflected and said, we have actually done very similar for fintech. And we have 3 principles on the whole financial services revolution in Singapore was built. And the core DNA. Israelis are successful in startups because of what they say is chutzpah, that they are fearless. They will just go fight it. They were not scared of failure. Singapore is reverse. Singapore's word is kiasu. We are nervous about failure. We are scared about a failure. And we will put all the checks and balances in place to prevent a failure. And that fear became the strength of Singapore. In a regulated industry, which is one of the most fiercely regulated, that fear and that consciousness of not violating the regulation created a culture of supporting that. Of course, a macroeconomic factor, historical trading post, English as a language, high education level, all those help. And that what crystallized over last few years was three principles which made Singapore as the fintech nation. One I simplify as right first, fast later. Very Singaporean way. It's okay. Singapore was not the first one to bring digital bank regulation. That's fine. We need to do it right in a way it's right for us. We don't need to race with Europe to bring the regulation. Singapore was not the first one to bring the open banking regulation. Last year, the Findex came in to help people judge about their financial health. We don't need to rush to pass a PSD2. Let's do what is right, even if it takes longer. So right first, fast later. The second one is what I say, Singanomics. So that's what I coined. Singanomics is a Singaporean model where the government will have a nudge. They will let private players compete and do everything. But when it comes to building critical infra, they can jump in, they can nudge state institutions to play. So there is a silent hand to ensure everything goes well, but it's contrast with the neoliberalism in some parts of the world and extreme state controlled from the other side. It's a fine balance. And the last one I say is garden innovation, because Singapore doesn't have a lot of resources. So every few years they pick. For next few years, these two things are our priority, and then we'll throw everything. 5 years ago was payments and blockchain. So then Project Ubin happened, Fast Pay Now happened. Last 2 years, they said green finance, sustainability, that's our focus. All energy goes on that. So that where there is a central decision that this is the priority. We will not stop anybody else, but this is the priority. We will throw everything we can at it. So those three principles. And the project is about bringing out the stories of real startups, real companies trying to adhere to it. So we are bringing a lot of regulators all over the world to learn from this. So I'm actually advising at least 8 regulators all over the world who want to pick the best practices from this. So the book is the journey encapsulated, where the central bank governor Ravi Menon wrote the foreword himself. And the project is about bringing these stories and spreading the love all over the world.
Varun, you're doing fantastic work at a very exciting time in this era. So I wish you the best of luck. And we look forward to hearing more fintech stories from you in the coming years.
Thank you so much, Tamir.
It's great to have you.
Thanks to our listeners too. Kopi Time was produced by Martin Taki. Daisy Sharma and Violet Lee provided additional assistance. It is for information only and does not represent any trade recommendations. All 41 episodes of Kopi Time are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. We thank you for your time and listenership. Bye-bye.